When you look at the trade war, it seems that, first of all, everybody in the market, or almost everybody, thought that there'd be a deal, even it'd be a smoke and mirrors deal. Then there wasn't, and people said, oh, well, they'll find a solution. And now suddenly, it's baseline, an ugly trade war that could last 5 to 10 years. I mean, are we flip-flopping to too optimistic to too pessimistic?
So I wouldn't call this a trade war lasting, 5 to 10 years. The fact that the disputes regarding Chinese companies and tech, that has just come so swiftly after the tariff standalone issue. This side of it is important. That is not just 5 to 10 years. That's going to be a multi-generational thing, right? So I think it's still important to separate the trade deal itself and tariffs, the impact, which, to be frank, is a bit more manageable for both sides, versus the longer-term strategic play, which is not just a Sino-US story, it's a China versus everyone story.
Okay, what does this mean for actually how the world economy, and what does it mean for the U.S. consumer?
Well, I mean, I think for obviously the most important thing is this separation, because we are going to be in a period of sustained competition between the United States and China going forward. And so that obviously has to shift investors' volatility assumptions going forward. But I think, it has to be played out how it's going to impact the U.S. and Chinese economy. I think they're very incentivized. Both players here are very incentivized to reach some kind of agreement, particularly with the U.S. elections approaching. And so our view is that they'll reach some kind of agreement in the near term, and the impact on the economy will be relatively muted so long as the tension doesn't, persist.
Scott, why is there a bid to fixed income assets? Price up, yield down. I'm looking at the U.S. 2-year yield. My eyes are failing me. 2.1957. Why is that, Scott? Is it the trade issue?
Well, yeah, I mean, it's increased geopolitical tension, right, Tom? We've seen that, and what we've seen primarily different in 2019 than 2018 is this risk parity, right? So treasuries rally very hard when we get a risk-off environment like we have this morning. A lot of that has to do with the pause by the Fed, with the patient language by the Fed. There isn't that kind of upward pressure on rates that we saw in 2018. And so as we looked at that chart just a minute ago about expectations for rate cuts from the Fed, that is going to be driven by this concern about geopolitical risk. I do think it's very important to separate the specific trade tension and the broader competition between the two countries going forward. Right now, the market is focused on both of those together. Comments about the new Cold War. I think you got to be very careful there with that analogy, because obviously the U.S. and China economies are very interrelated.